Hello and welcome. So in this lecture video, I'm going to be talking about lower of cost or market and do a practice problem associated with lower cost or market. And then we'll also talk about the financial statement effects of inventory errors in the end of period inventory count. So the inventory count that we do at the end of the year, what happens if we make a mistake when counting? How does that affect the financial statements? Okay. So let's talk about lower of cost or market. So our accounting principles in the spirit of conservatism. Remember when we talked about back in chapter 1, we talked about accounting, the way I see it at least, is it's a language that has some math. And we talked about what are some components of a language. Well, there's vocabulary, there's rules, and then there's also a culture. And I said, well, believe it or not, there is some culture to accounting and the idea of conservatism. So I was trying to frame that. I was saying that it's not in terms of political parties, but conservatism would say, for example, we want to be conservative and we want to require that inventory is going to be reported at either the lower of the market or cost. Okay, so that's what we're saying with conservatism. So we're saying you're going to choose, companies have to choose either the lower of the market or the cost. Now, if market rises above cost for your inventory, then you have to report it at cost. But if the market value drops below the cost, then you have to report it at market. That's the idea of conservatism. That's what's going on right over here, okay? So merchandise inventory, we know that's a current asset on the balance sheet, and it's reported at lower of cost or market. All right. So market value, what do we mean by market value? It's our current replacement cost of purchasing the same inventory in the usual manner. Okay. So the current replacement cost. So if we have a decline in our replacement cost, maybe, because of obsolescence of what we sell, maybe we have some iPhone 4s still sitting around. Well, the replacement cost of buying a new iPhone 4, right, is going to be a lot less than what we paid for it several years ago. Okay, so the value of inventory, especially iPhones, can decrease. So think about LCM if you're selling iPhones, right? New iPhone comes out, the value of old iPhones just dropped a lot because everybody wants a new one. Okay. So when the recorded cost of our inventory is higher than that of inventory is higher than the replacement cost, that means that the market is lower than the cost. We need to recognize a loss. When the cost is lower than the replacement cost, we don't have to do an adjustment. All right. So we're going to apply LCM here in this case to individual inventory items. We could do it in a different way, which is to apply it to major categories of items, or we could do it at the entire inventory level. But here we're going to do it in terms of our individual items of inventory. All right, then we'll do our comparisons for each individual item, comparing it from cost against market. Okay, so let's look at an example of lower of cost or market. So let's say that we have a motor sports retailer has the following items in inventory. So we have our Roadster cycles. We have 20 of those, and the cost of each is $8,000. And so then the total cost of 20 times 8,000 is $160. But then the market value of those has dropped. Okay. We have our Sprint. We have 20 of those. The cost was $5,000. The market value has risen. Okay. Total cost 5,000 times the 10, 50,000, and then our 10 times the 6,000, 60,000. Okay, so on and so forth here with our total cost and total market. We have our Trax 4 and Blazer. 8 of those, cost is 5,000, market is 6,500. 5 of the Blazer, cost is 9,000, market is 7,000 each. Okay, and so then the total cost of Trax 4 is 40,000. Total market of Trax 4 is 52,000. Total cost of Blazer is 45,000. Total market for Blazer is 35,000. So now we need to compare our cost to market for each individual item. Now, how do you think I'm going to do this? I'm going to do a table because I love tables. So I'll come over here and I'll say item. That doesn't look like an I. You can do better than that. Item. And then I'll say cost. And I'll say market. And then I'll do LCM over here, lower of cost or market. So I'll say Roadster. And so I need to do it total. So it's 160,000 right over there. And then my market, says it right over here, is 140,000. Which one is lower? Market. So I put down the market. Okay. And then I do the same thing for the Sprint. Total cost, 50,000. Total market, 60,000. Which one's lower cost at 50,000? Okay. Then I go on to Trax 4, right over here. Total cost, 40,000. Total market, 52,000. Which one is lower? My cost, 40,000. And then finally, I can look at my last one, which is Blazer. Okay, and I say total cost is 45,000, and then market is 35,000. Which one is lower? You tell me. Market, 35,000, right over there. I add up all my LCM, and I'm going to add up all my costs right over here, and I have my total cost that is shown right up here at 295,000. And then my lower cost of market is 265,000. So it's a difference of 30,000, right? Okay. So what do I need to do with this? Well, here's the thing, right? Is on the balance sheet per the cost principle. What is the value of our inventory on the balance sheet right now? It's 295 because remember, per the cost principle, we showed it cost. But we have a twist on the cost principle here with inventory in the sense that we need to show it at either the lower of cost or market due to conservatism. So right now, inventory is at 295, but we need to show it at 265. Merchandise inventory is an asset. So I have my T account here for merchandise inventory, and what I have is right now, it's at 295. But what I want it to be, I have to report it at 265. So this is what I want my ending inventory to be. So in terms of debits and credits, what do I need to do? I need to put a credit here. And when I put a credit there on my merchandise inventory T account, 295 minus a 30 gives me my 265, and I'm good. So we know we're going to credit merchandise inventory, but what are we going to debit? We're going to debit cost of goods sold. Okay. So our journal entry will be debit COGS, cost of goods sold, for 30,000. Credit MI, merchandise inventory, for 30,000. Now, what I just did right over here was increase cost of goods sold. What happens is cost to net income as cost of goods sold goes up. You tell me, think about it. Net income will go down. So after I do this journal entry, right, net income will go down. All right. So let's look at financial statement effects of inventory errors. And so what I'm saying over here is that companies need to be really careful when they're doing their physical inventory count at the end of the accounting period. So we'll say at the end of the year, when they go through and physically count all their inventory, because if they mess up, that can influence, right? That can have an influence on our financial statements. Okay. It can cause problems in cost of goods sold. And when it causes a misstatement in cost of goods sold, that can cause a misstatement in gross profit, which then causes a misstatement in net income. And then causing a misstatement in our physical inventory can understate or overstate our merchandise inventory, which in merchandise inventory is part of current assets, right? So current assets could be too high or too low. And then because gross profit could be too high or too low because cost of goods sold is too high or too low. Remember, net gross profit is too high or too low. That causes net income to be too high or too low. And then it causes equity to be too high or too low because remember, net income, as we saw back in chapter 4, is closed out to capital and then to equity. Okay. Furthermore, inventory errors can cause problems in next period's financial statements because the ending for one period becomes the beginning for next period. So let's think about that. Let's say at the end of 2019, we had $10,000 worth of merchandise inventory. On December 31st, 11:59 p.m., we had $10,000 worth of merchandise inventory. Turn the clock 1 minute forward. That's January 1st, 2020. That is beginning inventory. So that $10,000 ending December 31st, 2019 of $10,000 becomes beginning January 1st, 2020. Ending inventory 2019 becomes beginning inventory for 2020. So if you mess up ending for 2019, guess what? Beginning for 2020 is also messed up. That's why when we were saying at the beginning of chapter 6, you need to be really careful when you do these end of period inventory accounts. You have multiple counters and count it a couple times. Okay, make sure it's right. So if we have an understatement in ending inventory, right, what that means is that our cost of goods sold will be too high. So let's look at this. So we have beginning inventory plus purchases, right? And then that comes into our merchandise available for sale. And then remember that comes over here to ending and then to cost of goods sold. So if we understate ending inventory, so this number is too low, this number stays the same. That means this number is too high because this has to be either going here or over here. So if this is too low, that means this is too high. That means net income goes down. Net income's understatement. Okay. If we have our understating beginning inventory right over here, understating beginning inventory, that flows over here. That means cost of goods sold is too low because this number is too low. Because this number is too low. If we overstate ending inventory, that means this number is too high. That means this number will be too low. As cost of goods sold goes down, what happens? Net income goes up. And then if I overstate beginning inventory, this number is too high. That means this number is too high. That means this number is too high. As cost of goods sold goes up, what happens to net income? It goes down. Okay. In terms of the balance sheet effects, if I understate ending inventory, this number is too low. That means our current assets are too low, right? And that means equity is also understated. Why is that? Well, let's look at this. Understate ending inventory. Look at what happens to cost of goods sold. It's too high. Cost of goods sold is too high. That means net income is too low. That means equity is also low. Okay. And if I overstate ending inventory, let's look at that one that comes right over here, right? That means my assets, because ending inventory shows up in current assets, are too high, but overstating ending inventory means more of it goes here, which means less of it goes here. That means cost of goods sold is understated, which means net income is too high. Net income is too high. That's closed into capital and equity. Equity is too high. Okay? So it's really important to make sure you do the physical inventory count correctly. Okay? So I think what I'm going to do now is end this lecture video. In the next one, we will do these quick check problems and also talk about some inventory ratios. Okay? Thanks so much.